Hey everyone, Kristen Ambos here with Guaranteed Rate today with your coffee and conversation. Hope you're all doing well today. So wanted to touch base with you because I've had a conversation quite a bit in the last couple weeks and even months, but more so the last few weeks of, Kristen, I want to consolidate my debt, or I decided I'm not going to move and build. I just want to build onto my home, or I want to do some home projects and I need some cash to do that. And I have a lot of equity. So what is the best option for you? So let's break them down really quick. If you were to do a cash out refinance, when you do a cash out refinance, you do have to refinance the lump sum of the loan you have currently in with the new cash. What does that mean? Well, if you're at a 3% or right around their interest rate from a few years back, that means you refinance out of that interest rate into today's current rates in order to get the money. Okay, so let's say for easy math, you have a $100,000 loan amount, okay, and you want to cash out $25,000. So now you want a loan for $125,000. Your value of your home is there. Maybe it's worth $175,000. So you can take out that money. However, is it worth it to you to take your 3% interest rate now, pay that off, and take out $125,000 at 6.5%? Now, these are not quotes. These are just giving you examples, okay, of what the rates might look like. So you leave a 3% $100,000 mortgage for a $125,000 mortgage at 6.5%. Is that the right thing to do? Does it make sense? Well, we got to look at the scenarios put with it. Now, if you're looking for putting money into your home to help appreciate it and you'll get that back in return, I could debate that. I think that that's not a terrible idea. However, remember how far also into your 30-year mortgage, 20-year or 15-year mortgage are you? Have you already paid the majority of the interest and you're on the tail end? Or is it brand new and you just got the loan 2 years ago and you really have only been paying interest? Those are some things you want to talk to your lender about. Okay, now let's use it in the terms of debt consolidation. You have $20,000, $25,000 of credit card debt that you want to get rid of because those interest rates continue to go up every time the Federal Reserve decides to increase rates. So maybe you're at 20 or 22% on your interest rate for your credit card. Is it worth taking out a 6.5% interest rate, leaving your 3% behind in order to get rid of 20 or 22% interest? Well, yeah, anyone could make that case for you. You guys, that's really an easy sell. For a lender, I can work up those numbers and say, oh my gosh, you're going to be saving X amount of money over the next, handful of years. However, are you taking that $25,000, getting a 3.5% interest rate, and now paying on it for 30 years? Does that math make sense overall? We got to talk about it. So that's where a lot of this comes into. You have to have these conversations with your lender. And if your lender's not willing to have this conversation and just shuts down right away and says, nope, we're not touching it, or, oh my gosh, you need to cash out and refinance, get a second opinion. Okay. What are the other options then? If I have this equity, what are the other options? Well, there's a second mortgage option. Now, that cash out refinance, maybe you decide, nope, I'm leaving my 3% interest rate right where it's at, right? And I'm going to do a home equity line of credit. Great. These are higher interest rates than your first mortgage. However, again, not as high. If you're doing debt consolidation, not as high as a credit card. And if you're putting money into the home, then it appreciates. Now we're just looking for a payoff. The one thing I want to forewarn you on is if you go to a local bank or credit union, their home equity lines of credit are typically interest only. So let's just say those rates are somewhere around 7 or 8% today, because remember, your home equity lines of credit, your credit card rates, those variable rates are typically the rates that continue to move up when the Federal Reserve increases rates. So is a second mortgage at 8, 10%, whatever you're looking at getting, worth it? Well, let's do the math on that. In some instances, I say, okay, if you have credit card debt and you need to get out of that and you want to take out a second mortgage in order to pay at a pittance of the interest, maybe a half, maybe a third of whatever that interest rate looks like, and save you money, yes, go ahead and do it. However, if it is an interest-only loan, it is going to work like a credit card, meaning you will not get anywhere if you don't pay above and beyond the minimum payment. Now, in which case I see people taking these out and now their lines of credit, they're paying interest only for 5 or 10 years. and now they have to pay the debt off. Well, is that really saving you money? I don't know. We got to make sure that you're financially stable enough in order to do that. Or do you take out a second mortgage, guaranteed rate as a second mortgage? Ours is a fixed rate. Now, if you're looking side by side, you're going to see our second mortgage is going to have a higher interest rate. Yep, it does. I'm here to tell you that than a local credit union. However, ours is a fixed rate principal and interest. So you take out that 5, 10 years, whichever it looks like, your rate is dependent on the term and however much equity you still have in your house, you're paying at a lower rate than you would credit card debt. Even if you were to take this money out to do a home improvement, as long as you make your monthly payments, you will pay that off. You don't have to worry about your interest only and then paying over. Those fixed rate payments are going to have an end date for you, which in a lot of cases ends up being less expensive for a borrower, even though they're paying a higher interest rate, because they're actually getting to an end. There's a means to an end when you have a fixed rate. That principal and interest doesn't change. You pay it off every month, costing you less money. Maybe a little more interest up front, less over the long run. My point to you is there's a lot of opportunity out there, and there's a lot of different ways to get at your equity without disturbing the rest of your loan and the really low rate you have. So let's talk. Let's have that discussion. I'm happy to run all those numbers for you. You make the decision on what's best for you. Any questions, drop your comments below. Would love to hear more of the things you want to know when it comes to a second mortgage, home equity line of credit, or cash out refinance. Thank you. Have a great day. Cheers.